My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends, just trying to make you some money. My job is not just to entertain, but to educate, teach, and put days like today in some sort of context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. After the third straight beatdown in a row, Dow plunging 630 points, S&P plummeting 2.78%, and the NASDAQ nosediving 4.11%. Sell. It's tempting to try to learn something from the big bone crushers of the past so we can apply those bone crushers to the future. No two sell-offs are totally alike, but there can be similarities. Take the dot-com bust, which is the one that most people talk about. We had a huge lead up, the endless run from 1998 to March of 2000, followed by a rapid meltdown. Is that what's happening here now? Now that the NASDAQ's fallen 10% from its highs? I'm hearing about that buzz all day. Okay, at the beginning of 1998, the NASDAQ composite stood at 1,585. 1,585. It then roared to 5,100 by March of 2000, and then plummeted to 3,155 by May. Fast forward to 19 years ago, and a round trip to 1,585. It is your worst nightmare. Of course, there are other horrendous sell-offs from the past 40 years. The 87 crash averages were cut in half in a few hours' time. Financial crisis a dozen years ago, Dow was laid to waste, plunging from 14,000 down to 6,500. Then there's the COVID crash from earlier this year. Dow tumbled from 29,568 at the February highs to just above 18,000 in March lows. NASDAQ sank from 9,838 to 6,631. But it's that rebound from the March lows that's drawing comparison to the dot-com era. The NASDAQ surged 82% from bottom to its highs just in the last week, okay? For many portfolio managers who were around for the dot-com era, this is the kind of move that reminds them too much of 1998 to 2000. That move right there is what got so much fear that it's palpable. Now, last week I called in from vacation to make the point that no two sell-offs are the same. But you know what is the same? This is what's the same. Greed is the same. In other words, history doesn't repeat itself, but it often rhymes. We know there are lots of new investors in this market. Between the $1,200 stimulus checks, the generous unemployment benefits through July, and the advent of commission-free trading, millions of younger people have been drawn to individual stocks. Generally speaking, I think it's a great thing. It's great that there are more people trying to benefit from the greatest engine of wealth creation in history, which is why I always welcome the newbies. And they initially weren't greedy. However, rookie investors tend to make rookie mistakes. They don't know the history. They don't know what they own. And if they got in during a bull market, they may not realize that stocks can actually go down, especially if they're acolytes of my friend Barstool's Dave Portnoy, who embraces the idea that stocks always go up. Now, obviously, it's tongue-in-cheek, but you know what I mean. Me? Well, you know what? I have too much history, and history tells me to be worried about greed. I always figured if we ever got to a situation that looked remotely similar to 2000, I made a promise to you, the viewer. I would tell you to take some realized gains. You can't just let it roll. You have to take something off the table, even if it's necessarily to get a little bounce tomorrow. Even if it's not necessarily right here. Look at how far we've come. Greed. I don't like greed. All right? Now, we have been through a hideous 3-day losing streak, and this is really the deciding moment right here. Other than a handful of big crashes, 3 days is usually when the selling dries up, particularly for tech, which has borne the brunt of this decline. I think the best-of-breed tech plays can rebound here after a sell-off in the morning. Get this little sell-off, people panic, Europe declines, and then I think you can do a little buying. But listen to me. Even though we're entering a seasonally positive portion of what's historically been a terrible month for stocks, we've got to be careful. We get that lower opening tomorrow. I know my charitable trust will be a buyer, not a seller. Kind of finished selling. She's sold every tech, something at every single tech stock we had, including some that I won't mention. But I still want to flesh out my comments from last week when I called in for vacation, not just because someone described me as looking like a tomato. which is deeply unfair to my beloved beefsteaks. We need to circle back, not because I want you to be afraid, but because at some point you have to declare victory on something, please. Now, let's say we were at the horse races. You put your money down, and if you win, you collect. You go to the window. It's finite. If you decide to bet on an NFL game, you don't let it ride. You can't. You won. You go collect. Don't ask me how you collect. The stock market's different in the market. See, it's a different market. There's no window. There's no collection. The wager doesn't end until you decide to cash out. That's why I'm always telling you to take some profits while you have them. You don't want to get too greedy. You want to be disciplined because discipline keeps your paper gains from turning into real losses. Unfortunately, every new generation of investors seems determined to learn the lesson the hard way. They don't want to cash out. They want to let their gains run. They think guys like me are silly fuddy-duddies, like I never did this myself. It's like they have no fear. Of course, they do. They have no fear because young people think they're invincible. It's the oldest story in the world. So listen, if you're part of this rookie cohort, believe me, I get it. You had all these grizzled money managers telling you to stay the heck away from the market during one of the greatest rises in history, March, April, May, June, July. Their fears turned out to be irrational. You made a fortune if you bet against them. They were the scaredy cats. You were the opportunist. You got it right. But you can now get it wrong unless you ring the register on something. I don't want to be one of those scaremongers. I'm just beginning. Look, here's what I'm doing. I'm telling you to have some discipline. I expect this market to have a near-term bounce, and discipline means you should sell something to that rebound. Not because the sky is falling. It isn't. Simply because letting all your gains ride is insane. By all means, leave something on the table. And if you have some spare cash, maybe if you just dodge a 10% decline, you do something. But I do want you to play with the house's money if you're up huge. First, why do I say this? Well, because when the market goes up this far, this fast, you're going to run into stocks that can't rally even when they report great results. And that's what happened to all sorts of terrific but overextended tech names last week, including a couple you'll hear from this show. Whenever you see that kind of action, it means you have to do some selling. That's a classic warning sign, even if the companies are great. Second, right now we're witnessing a rotation that's all about a return to normalcy. What does normalcy mean? More travel, so the airlines are going higher. More dining out, so Chipotle and McDonald's and Darden do better. More shopping, so some of the down-and-out retailers that have been left behind can play catch-up. Sure, we have no vaccine yet, and a promising one from AstraZeneca was just put on hold because of an adverse safety event that may cause some people to think, you know what, maybe I shouldn't be in the trials. But you have to admit that things are getting better in the economy. You might think it's weird that we got a terrific employment number last week and it caused the market to get hammered. But that's because big institutional money managers tend to abandon high-flying tech stocks when it looks like business is picking up. Instead, they swap into companies that thrive when the economy accelerates. We also call them the cyclicals. Problem is, tech's gotten so big and the cyclicals have gotten so small that this rotation's crushing the averages. Third, when we get back from Labor Day and election year, politics becomes front and center. Right now, Biden's leading him while he's no Bernie Sanders. If anything, Biden's about as business-friendly as Democrat can get. He still wants to roll back Trump's corporate and capital gains tax cuts. That means lower earnings per share and lower profits, net profits to you. Whether or not you think that's good policy, it's a concrete negative. Finally, there's so much money in so few stocks, amplified by so many stupid ETFs. I went through them. Those people who issue those should be ashamed. It's entirely possible for big declines in Tesla, Apple, Microsoft, Amazon, Facebook to pull down the entire S&P 500. Bottom line, when we rebound from this sell-off, of which I think we will because it does tend to happen, I'm insisting that you take something off the table into a bounce. Not because you're afraid, not because I'm afraid, but because it's rational. When you win big at the casino, you don't go all in on the next hand. You cash in some of those chips and buy yourself a nice sweater, or maybe, if you really hit it, one of those Brad Pitt sports jackets from Bioni. Wow, there's something.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.